Good afternoon, and welcome to the Taxes and Retirement webinar. I want you to envision something. I want you to envision the dollar that's in your pocket and take that out for a moment. And I want you to envision that that dollar represents your whole retirement nest egg. Everything that you've worked for, invested in, and saved for over the last 40 years. This is your pension, your 401k, your IRA. It's your primary home, maybe a second home that you've purchased all through your working years. Everything that you've done without and sacrificed for is in this dollar bill that you just pulled out of your pocket. And now this dollar bill must last you at least 35 years in retirement. But there's a problem. Uncle Sam is going to want his share of that dollar. And generally, it's a third. Tear a piece off for the IRS. Inflation is going to want a piece of that dollar. And it's rising at over 2% annually. Make sure inflation gets their share. Healthcare. The single largest expense you're going to have in retirement. And it's rising at 3 times the rate of inflation. Tear a large piece off for healthcare. And then finally, there's the children. They may want you to pay for that wedding, or you may want to give them a better start than you had. Maybe it's a first car. Maybe it's a down payment on that first home. The children are going to want their share. And even though you'll gladly do it, tear a piece off for them. This is it, folks. A very tiny piece. This is all that's going to be left for you after you handle all of your responsibilities in retirement. You're here today to learn how you can put this dollar back together. And what we believe it starts with is minimizing taxation in retirement. My name is Joseph Malfeo, and along with my colleague Matthew Maiers, we want to thank you again for attending the Taxes and Retirement webinar. We're going to take you on the beginnings of a journey that can result in tremendous success if you implement the strategies correctly. An opportunity to raise your confidence in retirement and tax planning matters. Before I turn it over to Matt, I'd like to mention a couple of things with your screen today. You'll see that there's a Q&A tab found on the right-hand side. It allows you to ask questions privately to us. We'll log in. We will log your question and respond to you after the presentation, though, because we don't want to break the presentation up. If you want to see the presentation screen larger, just minimize that Q&A tab on the right, and then you can reopen it when you need to ask a question. That's the Q&A tab. You may also find a scheduling link that is going to appear throughout the presentation, generally from the left-hand side of your screen. It allows you to schedule a complimentary consultation with us. By clicking there, a Schedule Now button will appear in a different tab of your browser. Simply navigate to that tab quickly. It'll give you a really quick opportunity to schedule, and then you can navigate back to the presentation. And then finally, or you can wait for that piece near the end of the presentation as well. And then finally, we ask that you fill out a brief survey at the end of our presentation in order to let us know how we did today and to give us some feedback and how to improve our webinars. So with that, I want to turn it over to Matthew Maiers, our tax consultant specialist, and he's going to begin the content. Thank you.
Thank you, Joe, and good afternoon, everyone. My name is Matt Maiers, and on behalf of Joe and myself, again, thank you for taking the time to join us today. We are so excited to have you online with us today. This used to be our educational workshop. We are based out of Apex, North Carolina, but we service the whole triangle, and we used to do these workshops live. So we're happy to be up and running on these again and actually do these in a virtual format. A little different because we always love seeing everybody in the audience and taking feedback and questions, but we're going to do the best we can to, as Joe said, bring you on our journey today. That's going to give you some great information and hopefully some good insight on how you can potentially save taxes now and also in retirement. The title, as you can see, is Taxes in Retirement. And after that, it says, after the Tax Cut and Job Act of 2017, the Secure Act of 2020, the CARES Act of 2020, and then finally the American Rescue Act. And I say that with a little chuckle because very rare do you see this much changes in taxes, this many changes in taxes over a very short period of time. Both Joe and I have been in the financial services business for over 20 years, and we've seen changes in taxation, but this has been a wild 2 years. So the content of this is really going to be geared around some of the more pertinent things that we're seeing change right in front of us each day. But before I dive into the content of taxes, just because I always like to do a little trivia, wanted to share a couple tidbits out there, just tax trivia that we always find interesting. First is, everybody says kind of tax rates are high, they're low, they could be lower. We want them to go lower. But does anyone know, and I'll say this, obviously I can't see your answers, but hopefully you can think in your heads, when the first income tax rate was introduced. So the first income tax rate, and I'll give you a couple seconds, give you a little hint. This was actually a while back, and I'll say this as a reoccurring theme. Wars are expensive. So the first income tax rate. So if you're wondering, it was actually on August the 5th, 1861. It was created to fund the Civil War, and it was a flat 3% on income between $600 to $10,000, and then a 5% tax on income over $10,000. So that was the first, August 5th of 1861. Now the next would be, how about the highest? And I know we feel like we have high rates, but the highest income tax rate we have seen. And again, I'm going to go back to my reoccurring theme. Wars are definitely expensive. So if you can think back, it's not World War I, but let's think back to kind of World War II era, 1944. Okay. If anybody want to take a guess at what the highest income tax bracket was that we have ever seen, it was 94% on income over $200,000. Okay, in 1944. So it's safe to say we're definitely getting a little discount over that today, even though we might not feel it. My example would be is that there was a very well-known actor that became president that used to make movies in the 1940s. Ironically, this person was the same person that when he became president actually was able to get the tax rate back down, and it was Ronald Reagan. But I always use the tidbit that in the 1940s, he used to make about $100,000 per movie that he made. So during this time period, he would basically only do about 2 movies a year. People used to ask him why. Well, if you think about the flat tax of 94% over 200,000, he didn't want to make any more than 2 movies because he would be taxed at a much greater rate. So that's just my little example there. And then the last one is a little more pertinent to our lives today. The Tax Center always gives us some estimates each year around the number of taxpayers or the number of people that don't pay taxes each year. And it's been very similar now for the last several years. I know they already have some estimates out there for 2020. I know tax deadlines were pushed back this year, so we won't know necessarily all those until we get into the later part of this tax season. But any guess on what percentage of people do not pay taxes? And this is based off the last several years, so 2019, 2018, and it's pretty close to what they're projecting from the Tax Center for 2020. It is projected that 47% of people will not pay taxes or did not pay taxes in 2019, and a very similar amount will not do that in 2020. So I tell you that because, hats off if you're a part of that group that has not paid taxes and will continue to not pay taxes. But that being said, what that also tells us is that 53% of the population is carrying the weight. So my thought there is if you're part of that 53%, as most of us are, how can we work things better? How can we make things better for you now? How can we make things better for you in the future so that when you hit retirement, you're taking income from things and you're pulling income from ways that are creating the least amount of taxable income to you. So that is the goal of today. So our goals, understand all these relevant changes that just happened under all these different acts. Secondly is understand the impact of taxes on retirement income streams. So my example would be is when you start taking income from a retirement plan, what is the income going to be? What's the income tax going to look like on that? If you took it from a Roth, if you took it from a traditional IRA, what are the differences? Identify some tools and strategies that are available to possibly reduce income tax. This is not a product presentation. There will be no mention of any products or any solutions out there that we would recommend. As I said, Joe and I have been doing this for a long time. The reason that we put this presentation together, because it was the most widely requested presentation that we get asked to present on, is that most of the time, our clients, after they've come to us, have said the reason that we really enjoyed this is because when I used to go to my CPA, okay, if I was using a CPA and used to ask him about my taxation or what I should be doing to minimize taxes, he would say, send me your things over towards the end of the year or beginning of the following year, and I'll let you know what you owe on taxes. And if they prompted that person to answer any more questions about how can this potentially save me taxes down the road, they would simply get the answer, please talk to your financial professional or financial advisor. Then they would go back to their financial advisor and say, well, my CPA has told me to come to you and ask you questions about the impact of this taxation on this type of solution. And the financial advisor would say, that's great, but I'm not a tax professional. So that being said, please go back and talk to your CPA. And it was just a continuous circle. And there's so many things in between. And we are not there. I always say there's a difference between tax preparation and tax optimization. A CPA will do tax preparation. They will take all your documents over at the end of each year, beginning of each year, and set you up with the things you need to do to file for the IRS and tell you what you owe or tell you what refund you're going to receive. They're not going to sit down with you proactively over the course of a year, because that's not their job to tell you ways to minimize taxes either that year or in future years. And that's where we stepped in. We took the liberty to come out and really educate ourselves on taxation, what the different policies are, how they can impact you in the near future and beyond future, and really ways to optimize this picture for you throughout the year. One thing we're not going to do today is I will mention some things that have happened recently out of Washington, but we are not going to get into the political side of things, because we are big believers that we have to react to things that are happening. And one thing we can't control is Washington, D.C. Whether it's right or wrong or indifferent, we can't control what happens, but we can control the things we do to prepare and plan for things that are given to us. So those are our goals for today. So first, I'm going to start with, we talked about the Trump Tax Cut and Job Act of 2017. This is not new. I know we've been in these tax rates now for several years, but I do like to bring it back to a quick review. So what I'm showing you here on this page is basically the taxable income that you have in different brackets from basically 0 through over 600,000. Okay, so these are the ordinary income brackets. In black, you'll see the brackets as they are today. In red, in those parentheses, you'll see where they were before the Trump tax cuts took place. So my example would be is, if we're looking back to 2017 and forward, that first bracket, that 19,000 to 78,000, will be taxed at 15%, not 12. One thing I always point out, though, that I think is it's understandable, but I think it's sometimes good just to remind is this is a progressive bracket. Meaning that if I did my taxes this year, okay, for myself and my family, and I go through it all and I say, okay, I made $78,950 this year, great. The highest tax bracket I'm going to be in is the 12%. But then suddenly I go to turn in my taxes and I find out, well, I did not account for one additional dollar that I had. And that now pushes me into the next bracket, which is the $78,951. My question would be is, am I now paying 22% on all that taxable income, or am I only paying 22% on the dollar that went into that bracket? And the answer is I'm only paying 22% on the dollar that went into my bracket. So everything you see here is based upon income you receive. This is your salary, your wages, money that you're taking out of retirement accounts, traditional IRAs, 401ks. This would be money that you've earned and money that is coming out to you from qualified accounts, your retirement accounts, where everything is being invested on a pre-tax basis and you haven't paid tax on it yet. So this is income. The next thing I want to share with you, because it has been huge since 2017, is the capital gains brackets. Okay, capital gains works a little bit differently. So you'll notice the capital gains brackets, while they're still based upon taxable income, you'll notice that 0 to 78,750, it's a little bit different. The rates are different. So capital gains work on short-term gains and long-term gains. And I'll give you a quick example. This would be more for assets that you sell. Okay, this would be for property. This would be for stocks, investments, anything that you sell that you've owned. You're eventually going to have to pay something on that, some tax on that, and you would pay it by way of capital gains. So there's short-term gains, and then there's long-term capital gains. Short-term gains are anything that you've owned and sold within the year. Okay. Long-term gains are anything that you've bought and you've held over a year. So my example, I go back to one of our stocks we track is Apple. So if I bought Apple stock in December of 1980 for $22 per share, and I held Apple stock until just now, which this week it was trading around $125 per share, and I sold it, I'd be in a pretty good spot. Yes. Now, what would I have to pay on that? So I bought it in 1980. I sold it now. It's went well over that year. So I will pay long-term gains on the appreciation of that stock. Okay. And that long-term gains will be based upon this bracket that you're seeing in front of you, based upon my taxable income. Now, if I had sold Apple stock, if I bought it in 1980 in December and I sold it in, let's say, June of 1981, that would be within a year. Okay, and I would pay short-term gains. Now, short-term gains will be based upon the brackets that I showed you here a few moments ago. But the key to the story is that when you look at capital gains brackets, the Trump tax cuts did a wonderful thing when it comes to investing. They gave us an opportunity in that first bracket, that 0 to 78,000, to basically realize 0% on any gains in that first income bracket. So this was tremendously helpful for our clients who had held stock for such a long period of time, and they were looking to sell it off. They didn't know how they were going to sell it off or didn't want to pay all the gains tax right up front. This has given them an opportunity to not pay as much capital gains on it, potentially by way of what their income would fall in here. So it's incentivized us to save. It's helped us to kind of unwind some things. And you'll notice, that the largest part of that, 15%, even that's a discount to where it was back before the Trump Tax Cut and Job Act. So these are kind of where our brackets are. But, what's interesting about the Trump tax cuts is that the first year, they sounded so good. And it seemed like the first year that we began meeting with clients and talking about taxes, or at least what they had filed for their taxes, it was like, wow, I thought because the tax cuts were here, I was going to pay so much less tax. And I'm not. How is that possible? So what's interesting, I always say with every give, meaning with every give that there's a lower tax rate, there's a take. And the take was in how it went for the rest of everything else. So when we look at deductions, now deductions are something that's taking off, that basically is taken off your final tax bill. So once we calculate what your total tax is and your adjusted gross income, then we look at what deductions that you can take off that and minimize your annual tax bill. So basically the standard deductions as we stand today are $24,400 for married and $12,200 for single. Okay, so that's kind of was put in place by the tax cuts to kind of, I know it's sometimes hard to remember back then, but prior to the Trump tax cuts, they were about half that. Okay, so that was a big change. The standard deductions pretty much doubled from where they were. I know there's a lot of questions regarding kind of what's going to happen to taxes, and I'm going to get to that here in a little bit, especially as it pertains to the new administration and what they are referring to. But it's good to point out to note that the Trump tax cuts, for the most part, are set to sunset in the year 2026. Okay, which means we have these current rates from now until the end of 2025. Now, that's the big question: is will they do anything between now and then to change taxes? We don't believe they will. They're going to change taxes for some people, and I'm going to get to that here in a moment. But for the most part, we could see this lasting through 2025, which is good because we have some things at a discount, which I'm even going to go into more detail here in a little bit. We have some of these taxable brackets at a steep discount from where they were, things we should be looking at taking advantage of between now and then. But for the most part, in 2026, the guesswork is our tax rate's going to go up or down, and it's going to be hard for, I think, anyone to kind of sit down and have a conversation about tax rates going lower in 2026 with everything that we have going on and the debt we're accumulating as an economy. So if you'd ask me, Matt, what do you think is going to happen with tax rates? I'd say there's a good chance they're going to at least go back to where they were, because if nothing changes, those tax rates are going to go back to where they were prior to the tax cut in 2017. Could they go higher? Absolutely. But right now we have them. But from a deduction standpoint, to keep on the slide, there were a few more changes that were very important with the tax cuts. One was mortgage interest on debt up to a certain amount. It used to be $1 million prior to the tax cut. It went down to $750,000. Okay, so mortgage interest on debt up to $750,000, but they took away the ability to include the home equity line of credit. Many of our clients were looking at, obviously they had gotten home equity lines of credit and they were enjoying utilizing that as another itemized deduction. That was taken away in 2017. Charitable gifts. We have so many of our clients that love to give to charities because it's out of the kindness of their heart, but they were also able to get a good deduction from it on their taxes, and that stopped. And the main reason of it is because the standard deduction went up so high. So if they're contributing $1,000 here, and $1,000 there, and $1,000 here to certain charities, added up, it wasn't coming close to that threshold of the $24,004 if they were married, or the $12,002 if they were single. So that's why we saw a lot of changes as well. You know, how should I do my charitable contributions this year? Now, you'll notice I did put a couple things in red because the Trump tax cuts made charitable gifts or cash or check up to 60% deductible. Last year, during the CARES Act, they changed that to 100% of income. Okay, so the CARES Act came in between. CARES Act came in basically, well, they had the Secure Act that started in January of 2020. And then the CARES Act came in mid-year because of the coronavirus. So with that, they established 100% of income on charitable gifts. They've kept that. So they didn't take that away. They really took away everything else, which I'll get to here in a second. But also above the line deductions for cash contributions up to $300. So two of the things they established in the CARES Act last year, they actually have kept moving forward into 2020 and in 2021. So that's a good point to note. Next is qualified charitable distributions. I don't know if any of you have ever heard of this before. And this relates to, one of the things I'll say is that this kind of relates to our clients who are taking required minimum distributions in their IRA. So I'm going to go over this later too, but if you have a 401k, okay, and you retire, most of our clients will move that over to a traditional IRA, or some will keep it in a 401k. But at some point, that we've never been taxed on that money. Okay, so we've never had to pay taxes on any of that money, and therefore the IRS wants to receive taxes at some point. So they'll make us take distributions from our qualified accounts. This will be for 401ks, any IRAs you have, SEP IRAs, simple IRAs, pretty much any qualified retirement planning account. If you don't touch it, they're going to make us start touching it at now age 72. And that's changed. We talked about the Secure Act. I know the Secure Act sometimes falls in a back seat because it happened in January of 2020 and then COVID hit. But the Secure Act brought some pretty interesting changes with it. One was the fact that now you don't, if you're not of age, you don't have to start taking distributions, your required distributions from your IRAs or 401ks until age 72. It used to be 70 and a half. So with qualified charitable distributions, we found a way to plan with our clients because of this. We have many clients that get to the age of 70, we're getting to the age of 70 and a half, and now 72, where they do not want to take those distributions. They're like, Matt, we have other assets here. We have other things. We don't need to spend as much money. We don't really want to pay taxes on that. And there's not a lot of ways you can really save that because eventually the IRS is going to want their money on those accounts. But one of the things we look at is charitable distributions, meaning that if you contact the institution, if you're getting to be of age to take a requirement distribution, and you have a charity that you want to give to, or some type of a foundation you want to give to, you can contact the institution, the financial institution that houses that asset, that investment, and tell them to cut that check for your requirement of distribution right to the charity. Okay, and if you do that, okay, you're going to, number one, you're going to make good on your distribution, which you definitely want to do, but the income is not going to touch your hands. So there's an interesting thing. So keep in mind, when the income doesn't touch your hands, it goes to someone else. That's where you have the ability to maybe offset some of that income tax because it's never touching your actual hand. So a lot of planning we can discuss around there if any of you are in those age groups. Last couple things I'll mention, these have been in place for a while. It's the state and local property tax went up to $10,000, and you still have the additional $1,300 deduction each for ages 65 and over, and if you were blind. Credits. This is the biggie. Credits. They incentivize behavior. Credits are a little different than deductions because credits basically just take off your tax bill. They're not a deduction that you have to write off. If you have a credit and you're qualified for it, it's right off your thing. Now, I know there's some credits that have changed this year. One is because of the stimulus payments. You know, if you were someone that qualified for stimulus payments last year or the new round that came by Trump at the end of this year, and you did not receive them, you were able to basically put on your tax forms this year that you basically were required that you should have received this amount and receive it back as a credit. Okay, there's savers credits, there's child credits, education credits, healthcare credits, and earned income credits. Most of these, I would say, not most of them, all of them to some extent are based upon your income. So they might not be pertinent to everybody on the call, but I did want to mention a few on here before I go to, I want to spend some time mentioning the Savers credit, but I did also want to mention the child credit, because that's something that's changed recently with the American Rescue Act that Biden has just put in place. You've probably heard some rumblings about this. The child credit basically changed. It was at $2,000 a year for basically children under age 6, and it was $2,000 a year for children between the ages of 6 and 17. Okay, that has increased now to $3,600 for children that are under the age of 6, and to $3,000 to children between the ages of 6 and 17. The interesting thing about this dynamic with the American Rescue Act is they're going to actually, if you want to do it this way, they're going to actually front you half the money starting in payments this year, starting in mid-July. So there's a lot of different things that are changing with these acts that, not necessarily to the overall tax scene, but to these individual credits that are different than in years past. I want to encourage you, if you feel like you went this year and didn't get the opportunity to really figure out what credits are applicable to you, or maybe you're looking at this and saying, wow, I didn't really think I was eligible for that, but I may be, let us know. As Joe mentioned, there's a chat box in there. Please ask us your questions. Typically, we would do this live, but since we're in a virtual format, we wouldn't be able to go back and forth between the screens. But if you feel like you've went through some of these things and not received some of the full potential that you can, let us know. We can work through that with you and see if it's something that is applicable. The one thing I'm going to just talk about here for a moment is the Savers credit to incentivize savings. So I just want to give you an example. And again, I don't mean to be biased now to people that are married and filing joint, but I just want to keep things simple for the terms of today's presentation. So we're going to look at a couple age 65 and older. Okay, their gross income for the year on their tax return was $38,000. Therefore, they have the $24,400 standard deduction. They also have the $1,300 deduction for ×2 for both of them being over the age of 65, which gives them a total deduction of $27,000. Now, they contributed to their traditional IRA, and I'll go through some of the differences of that here a little bit. Throughout the course of the year, they contributed $2,000 to their traditional IRA throughout the year. Now, one thing sometimes people don't know is that the money that you contribute to a traditional IRA, and there's a certain cap based upon your income level, is tax deductible. So that $2,000 contribution is now $2,000 available for deduction. Okay, so the income they have subject to tax based upon their gross income is $9,000. Okay, they're basically at the 10% tax bracket. That's $900. Their Savers credit for the IRA. Now, this again is based upon certain income levels, but it can go up to half of the amount that you deducted. So basically, that credit in their case, qualified for half of what they did for contribution, which is $1,000, which took out their total tax bill, just like that. Now, most people aren't even aware that this can actually take place. Now, you'll notice some people say, well, that's great, Matt. There was $900 in taxes due and, $1,000 credit. Does the additional $100 carry over? And unfortunately, the IRS does not allow that. So that $100 extra doesn't carry over. But that's an interesting way to see how tax things can change based upon some of these credits. The real tax system, and I'm going to talk a little bit about different things here as we move forward through the slides, is the real tax system through the Secure Act. Okay, there's required minimum distributions, which are the RMD. I mentioned that in a moment ago, which was changed to age 72, not age 70 and a half. Traditional IRA contributions, meaning that contributing to your qualified accounts, you used to have to stop when you were 70 and a half. Now, because they upped the age to 72 on distributions, you can still contribute now up to age 72. The stretch IRA, is it gone? The Secure Act did something really interesting with distribution. So what it said, and I won't go, there's a lot to this, so I just want to mention a couple moving parts that may be applicable. One of the things it did was it took away the ability for beneficiaries to stretch their payments that they received from qualified accounts over their entire life expectancy. We're going to talk about Roth IRAs. I'm sure you've heard a lot about that in recent times. Is it the answer? Capital gains, Medicare benefits. How can things, is there any ways that Medicare premiums can go up? And we didn't even realize they could. And lastly, the taxation of Social Security benefits. So first, let's talk about the CARES Act, enacted in January of last year. Again, the waiver of RMD now turns to age 72. Okay, it says 70 and a half, now it's 72. Last year, you didn't basically, with the ability for the Coronavirus Act, you had the ability to take money from your retirement accounts and not pay the 10% penalty. That's gone this year. Okay, so that penalty, that enhancement's gone. And 401k loans were capped at $100,000 or 100% of salary. These are some things now that have went away since last year because this was more of a coronavirus thing. So the one thing I want to mention here before I go on is that when we look at the Secure Act, okay, this Secure Act was early last year. One of the things it did is it basically stated that if you have, let's say I have a 401k, I'm going to give you an example of my family, okay? I have a 401k, my beneficiary is my spouse, okay, and my contingent beneficiaries are my children. Okay, something happens to me, God forbid, that money will pass to my spouse and then will ultimately pass to my children. What the Secure Act stated was that if my beneficiary was not my spouse, okay, and they were just somebody that was 10 years older than me, basically what would happen is that money, if something happened to me and it passed to a beneficiary that wasn't my spouse, they were not disabled, they were not more than 10 years younger than me, and they were maybe a minor child, then if a minor child, meaning we're talking about under age 18, if that happened and something passed to them, they would have to take those payments out over a 10-year period regardless. So the stretch IRA used to say, well, if it passed to these people, they could take it over their life expectancy, therefore reducing the taxes. That's not the case anymore. So my question would be, if you haven't had time to review your beneficiaries on your qualified retirement accounts, it might be a good time to do that. This has also helped our clients take a look at doing some Roth conversions. Okay, there's contributions and Roth conversions, which I'll get to. Maybe designating beneficiaries in a lower income tax bracket might be the answer. Maybe letting other appreciated assets pass to other beneficiaries that are in a higher tax bracket. Because what will happen is if I own a big house or a big land or a big cash, a big investment, and I die, that money gets passed to somebody. And if I allow it to pass after I pass away, they get the stepped up basis, meaning that if I bought a house for $100,000 and it's worth $1 million and I die and it passes to my children, guess what? They don't inherit it from the day I bought it. They inherit it from the day that they inherited from me when I passed away. So if they sold it, they're not going to be liable for that $900,000 of money that appreciated while I was alive. So there's a lot of things to plan for. If you haven't taken the step to look at your beneficiaries, especially if you have trusts. People say, well, I have a trust and that doesn't matter. Not necessarily, because there's two different types of trust, and a certain trust will pay immediately out to the beneficiary now because of this new act, and a certain trust will pass to a trustee, which has a little more control. So I'd encourage you, if you haven't looked at this stuff in advance or now because of these things, definitely take the time to do it. Real quickly, I want to touch on some of the things that are happening here today, which is taxes, taxes, and more taxes. We probably have watched it on the news, all these tax things coming up. Markets are not accepting it well because there's so much concern around what's going to happen. Really what the new administration is proposing right now in Biden is they want to raise tax revenue by over $3 trillion over the next decade. They want to revert the top income tax bracket for taxable incomes over $400,000. That's the key. Over $400,000 from that 37% to 39.5%. Long-term gains, capital gains, and qualified dividends, they want to raise to at 39.6% above $1 million. That's a huge thing. We're hearing it right now. The gains rates are going up. The gains rates are going up. Yes, they are for income above $1 million. Okay, and the same thing for personal taxes above $400,000. The qualified business income deduction for self-employed, taking 20% of your qualified business income, that's going to basically go away if you make over $400,000. And the overall biggie is increasing the corporate taxes from 21% to 28%. What would this do? Okay, again, the corporate rate tax would be at 28%. The last time we've seen a corporate tax rate hike was in August of 1993. Okay, from 93 through 2017, it remained at 35%. Again, this is just corporate until the tax cuts reduced it to 21%. Here's an important point to note, though. The effective tax, meaning the tax rate that these companies actually paid after all their tax break and deductions by the end of 19, according to JP Morgan, was about 17.5, not 21%. So with this proposed tax hike, JP Morgan's also estimating that the tax rates will be around 21% effective, below the tax rate of 28%. So again, yes, it's going up, but not exactly what these companies are going to pay. The impacts of the overall plan, I think we probably have seen this before. There's going to be some impacts to overall GDP and capital stock, but really want to focus on the taxes today. And this is a slide. I'm going to spend a minute on it just because I do think it's important. Everybody is concerned around what raising taxes will do to our economy and our markets. And this is a slide. I know it's a little small on the right-hand side, but even if you just looked at the check marks, every time you see a check mark on that graph, it signals the time that personal taxes, corporate taxes, and capital gains taxes were increased. Okay, and the red bars state every time that we saw the markets, okay, the investment markets go up, even though the tax rates increased. So my point is, every year there's a lot of checks on that. Personal corporate gains, you look at personal and corporate, nearly almost every time. Corporate is the only two times we've seen that check mark on the thing, the market has went up. So I say that because the reason that happens, okay, you think, how would that happen? Taxes always mean bad markets. They do not, because there's things in place. There's other things happening in place, such as stimulus packages. You look at the acts that are being passed, a lot of the money that's being flown into the economy that are going to change the dynamic of that, so it doesn't necessarily correlate to each other. So just because we see raising taxes does not necessarily mean our economy or our markets are going to go down. Okay, so I want to get into some of the real opportunities here. So similar to the first slide I showed you, which is taxable income, where we were in 17 prior to the Tax Cut and Job Act, and then in 2019 where they are now. There's two brackets I really want to draw your attention to. That's the 78,951 to 168,400, or maybe 400. We're at the 22% income tax rate on that now. And the next one, which is 24%. If you go back to 2017, take a look at the difference of those brackets now versus where they are. One, we were at 25%, and the bracket widened. It went from 75,901 all the way up to 153. Look at the next bracket, 28%. That's a 4% discount. And we went from 153 to 233 on the left-hand side to 168 to 321. Huge jump. That's a 4% discount. What does this mean for all of us? There's an opportunity here with Roth IRAs. And we're not saying Roth IRAs is right for everyone, but let me give you an idea how they may fit. Okay, Roth IRAs are a little different than traditional IRAs. Traditional IRAs are money that you put into, you can contribute money per year. So a traditional IRA and a Roth IRA, you can contribute $6,000 a year if you're under age 50 and $7,000 a year if you're age 50 and older. Okay, it's kind of if you're over the age of 50. The difference of Roth IRA is when you put the money in, you're taxed on it now. You're taxed on it when you put the money in, and you have to report it in the year you do it. But when you take it out, it's not taxed. Traditional IRAs, you put the money in, it grows tax deferred, and then when you take it out or when the IRS makes you, you pay full tax. Okay? With Roth IRAs, any money you put in, you can always take out your contributions. You cannot take out your earnings until you're above the age of 59.5%, or if you're already over that age, they have a 5-year rule. But the one thing about Roth IRAs is there's no RMD requirement. So at the age of 72, you don't have to take any money out of it because you've already paid taxes on it. This has created a huge opportunity to convert. Now, the one thing about Roth IRAs is if you're working and your income's too high, you may not be able to contribute to one, but you can convert to one. And we will say that between now and 2026, this is a huge opportunity because our tax rates, for the most part, if you're under that 400,000, are going to be on a discount now. Hopefully until the year 2026. And by doing that, you're going to create more tax-free income for yourself down the road during retirement. So again, it's not right for everybody, but if you have not had an opportunity where you just shied away from Roth IRAs, they were created in the 90s. That's how long they've been around. They're nothing new, but there's a great opportunity to see how they might be beneficial for you. Capital gains, I'm not going to focus on too much, but I do want to just mention if you're from an investment perspective, especially when the markets are going crazy like they've been last year with COVID, mutual funds are definitely something that you want to take a look at. I use the example. Let's say I'm a mutual fund manager. Okay, I'm mutual fund manager Joe. So, and Joe's on the call as well. So Joe's a mutual fund manager, and he's been a manager for a very long time. He's part of a growth mutual fund that bought Apple stock. He was convicted to buy Apple stock in 1980 at $22 per share. Okay, he bought it in the mutual fund. His mutual fund is thriving today. It still is right now. And as an investor, Matt comes along and buys into that mutual fund last week. So I come in and say, wow, this mutual fund has the best track record ever. I'm going to go ahead and invest my money in this mutual fund. And I buy into Joe's mutual fund that owns Apple stock. Now, Joe, for whatever reason, decides, you know what? Apple's not going to cut it for me anymore. Something's coming up in the news and I don't want to own Apple. And he sells it this week. Okay. He sold it this week when Apple was $125 a share. Now, I don't have any idea he's selling it, correct? Because he owns the fund. I don't own the stock itself, Apple. I own the mutual fund. I don't have any control over whether what he buys and sells. Well, he sells the stock. He bought it at $22. He sold it in the mutual fund at $125. Do you think I have to pay capital gains on from the day I bought it, which was last week, or the entire time since Joe owned it, since 1980? And the answer is, I'm going to pay the capital gain since he bought it in 1980, even though I bought into the mutual fund last week because I love the fact he owned Apple. He sold it and I have to pay taxes on it. Capital gains in mutual funds are there because you don't see them. That's why we sometimes get these things and say, well, my portfolio was down. Why am I paying these taxes? Because managers are buying and selling in there, and we have no idea why they're doing what they're doing. But at the end of the year, we have to report those as short and long-term gains. So if you own all mutual funds, definitely something that you want to look at. We can help you kind of look through those things and see what's there, but definitely something you want to be aware of within mutual fund investments. Medicare, I'm not going to talk too much on today, but obviously there's 4 parts to it: A, B, C, and D. So hospital, drug, Medicare Advantage, and drugs. I did want to point out, though, if you look at some of these things, it says Part A and Part B and Part D. Look at the bottom of the slide for a second. It says premiums for 2019 are based on 2017 income levels, meaning that if suddenly I sell something this year, let's say I own a real estate property, and I sell it, and I have all these gains coming in, it's a one-time event. Okay, let's say I did that in 2017. I sold this big property. I made $200,000 on it. It wasn't my primary residence. It was a secondary. So I have to pay capital gains on it. Suddenly, my income comes in, and now where I was originally maybe the 0 to 170 bracket, now because of that 200,000, guess what? I might be in the 320 to 750, and my Part B and Part D premiums may raise for something I did 2 years ago that was a one-time event. So I just point this out that if you're doing these things, there's a way to do this. The IRS has a form that you can fill out for a one-time event if you are selling property or realizing a gain, but that's something you want to consider. I mean, the increases are not astronomical, as you can see, but I would want to know if there was any increases in anything I had moving forward, especially if that wasn't a true case of what my income really was. So Social Security, one of the biggest mysteries of how in the world is this thing taxed? That's one of the biggest misconceptions, I think, is 85% of my Social Security taxed. Not so much. I am going to try to explain this in a few minutes in the simplest terms I can. It's taxed on a term called provisional income. Okay, provisional income decides how much Social Security is taxed. And the way this provisional income is defined, it's 50% of your Social Security benefits. I know they don't send out the statements every year like they used to, not unless you ask them to. But think about if you log in and you see what your target of Social Security benefit is, pretty much take half of that, and then they're going to add that to any income that you have, so any ordinary income that you're realizing, any dividends and capital gains, and then a non-taxable interest. This would be, let's say, a tax-free bond or something like that, a municipal bond. They're going to look at that together, and they're going to say that is your provisional income. And how they calculate how much is taxed is they look at 2 thresholds. Okay, so I'm going to stick with the married filing joint at the bottom so it's consistent. They look at the number 32,000 and 44,000. So that big number that they calculated a moment ago, they're going to say, how much did that number go above 32,000? And then how much did it go above 44,000? Okay, so rather than trying to understand it from this slide, I have a real life example I want to share with you that I think will help you understand a little differently how it's taxed. So let's say, real life example, okay, we have a married couple over the age of 65. They have $20,000 in Social Security, okay, and they have taken a $40,000 withdrawal from their traditional IRA. Okay, so remember, provisional income is half of Social Security, so that's $10,000 plus everything else. So plus the whole $40,000 withdrawal. That leaves you with $50,000 of provisional income. Okay, so the first blue block. Okay, so how much did the $50,000 go above the first threshold of 32? It went $18,000 above that. So 18,000 times 50% or 0.5 is $9,000. The next block to the right. $50,000 went above the $44,000 threshold by 6,000. Now 6,000 then is now times by 35%. They can't do 85% because they've already taxed the initial thing at 50. So now the remaining amount's taxed at 35% or 0.35, which gives us 2,100. So that gives us this is key, total taxable benefit of 11,100, not the tax due. Okay, the total taxable Social Security benefit, if they had 20,000 of Social Security, $11,100 of their 20,000 is taxable at 55% of their total benefit. Okay, now that's taxed then. That 11,100 is taxed at the ordinary income rate that you fall into. Here's how you could do something a little different. So what if this was an example and we were looking at how we could take things differently? This is things you have to plan for in advance, because once you take Social Security, it's there. You take it, it's done. You can't change it. This stuff has to be done in advance, and it requires prior planning, which is what we will help with. $40,000 of Social Security, so a little more Social Security, okay, with only a $20,000 IRA withdrawal. Okay, so keep in mind the provisional income would be half of the Social Security to 20,000, and then everything else. So the 20,000, which is 40,000 of provisional income. So 40,000 goes above 32,000 in that bottom left box by 8,000. So 8,000 of it is taxed at 50%, 0.5, which is 4,000. We didn't even go above the second threshold of 44,000, which means our total taxable benefit. So out of $40,000 Social Security, our taxable benefit, the total taxable benefit is $4,000. That's only 10% of the Social Security benefit. And how it works out to be is if I'm taking this IRA, I have my 11,000, the first example, I have my 11,100, my $40,000 IRA withdrawal. It gave me total taxable income of 51,100 minus my standard deductions for being over 65. Then it gives me basically a net tax of 24,100, which means I owe 25,11 in that tax bracket. The second scenario with what I did means basically I only had $4,000 of taxable Social Security. My other taxable income is 20,000. That gives me a total taxable income of 24,000. My standard deduction of 27,000 wiped it out, and there is no tax due. These are things that we can help you with planning. Is how do we turn everything you have into income streams when you hit retirement, where you're paying the least amount of tax possible. So again, this is one example. This is how we begin with our clients. We start with what we call a tax map. Okay, this is a red graph that goes from left to right. This basically shows us the ordinary income brackets, 10%, 12%, 22, 24, all the way up to 37. You'll notice there's a little gap there from 0 to 20-some thousand. That's standard deductions taken out. Keep in mind, we're using our clients that are over age 65, but it helps us understand, just like we talked about, the effective tax rate. We want to know our marginal, we want to know the effective tax rates, meaning what our clients are going to pay, and we want to know what their marginal tax rate is going to be, meaning that here's where they land on the map. And if they do something else, here's where they're going to go. And basically, if they decide to sell something and they think, well, I'm in the 22% bracket, but they decide to do something that lands them in the 24% bracket, we want them to know about that. And we want them to know about it in advance. So I'm going to share with you an example, a real life example that really hit Joe and I close to home, because it was one of our retired clients, fantastic people. They really, they followed kind of our guidelines the whole time, but they're coming up in a scenario where basically, we obviously didn't put in their names, but they were both above 65. They had $60,000 of combined Social Security between them both. Okay, that was their Social Security benefit. They had $15,000 of net long-term capital gains for the year. And they had $45,000 of required minimum distributions that they were taking. This was basically when you had to take them when you're over 70 and a half. They crossed over when they retired. And their question to us was, I want to go ahead and take some money out of my IRA, my traditional IRA, to give to my kids. So they said, we want to withdraw basically $1,000. We want to take it from our IRA. Let's go ahead and do that. Would you agree? Now, here's what's going to happen here. This is their tax map if they did what they just said. Okay, so when you look at their tax map from left to right, basically you can see that with their standard deductions, they should be paying at 27.5, right? That's where the red starts right before 30. But what's interesting is that you can see that they start to harvest a little over $10,000 in ordinary income. When they get to $10,000, they begin to experience an 18.5 effective marginal tax rate. Okay, that's the point when their ordinary income plus all their capital gains that they have start dragging in Social Security into the calculation, which means that every additional dollar that they take from their IRA at this point is taxable at 10%. And then every additional dollar they take over that is going to drag in another 85% of Social Security into the mix, which then basically it makes their effective margin rate at 18.5%. And then they basically go to 22, all the way up to 49.95% before it drops down, because Social Security can only be taxed so much. It's crazy. They go from 18.5 to 22% to almost 50 before dropping back down. And the question would be, is how did this happen? Well, it happened because this. If they take $1,000 withdrawal from their in their IRA and they're in the 12% bracket, they should pay. If they take out $1,000 in their 12%, they should pay $120. That's exactly what happened. So if they take that $1,000 out, they're going to owe taxes on $120 of that. But that causes $850 of taxable Social Security, okay, which amounts to another $102 in taxes due. Then that causes $1,850 in capital gains to be taxable at that 15% bracket, which is an additional $277.50. That means the total tax burden on that $1,000 withdrawal is $499.50. That's nearly half the withdrawal. So when they ask us the question, should I do this? Our answer is no. We should look at other areas, because there's no reason why we'd want to be penalized on half the withdrawal. These are the types of things that we try and put in place before time. So when you're at the moment of taking retirement income, you've already prepared from where your withdrawals are going to be. And that's kind of what we look at for tax controls. Think about what you have right now. Do you have IRAs? You might have 401ks if you're still working. Do you have outside IRAs, traditional IRAs? Do you have Roth IRAs? Have you contributed to them? Do you know how to do Roth conversions, even if you're above the tax limits to do them? Have you started them while we still have these good tax rates? Do you have non-qualified taxable accounts, meaning brokerage accounts, things where you're paying every year on short-term gains and long-term gains? Do you have a whole mix of these accounts? Have you considered really taking the time to sit back and figure out what assets should be held in which account type? And have, more importantly, if you're getting close to retirement, where your income is going to come from first, because that is going to really be a good tell of how you're going to be taxed and how, if you can minimize your taxes. Because we talk about diversifying out amongst all these different things, so we have options and ways to take retirement income. Have you updated your beneficiaries, as I said, because of the Secure Act, your qualified beneficiaries, knowing that we won't have forever to stretch the payouts anymore and taxation might become a little quick. One of the things we offer, we went through a lot of information here. I hope you've seen our box pop up in the upper left. It's for a complimentary consultation. We do a 30-minute complimentary consultation to review your tax map, that red map that I showed you, where you are, where you could be. We have a fact-finding thing that helps us get to know you better. We can also help you out with income planning and financial planning. This 30-minute consultation is just to get to know you better. Really, the floor is yours. See where you're at, see what you have, see if there's a fit for us to move forward. And then we even do a second consultation with the information we gather for free to show you different things maybe you haven't thought of, blind spots, ways that we could potentially help you reduce taxes. This is all complimentary, and it's all a good way to do a check. Even if you had these done in the past, or if you've had someone, you looked at them, or you do your own stuff, take the chance here in a moment to do it. Because many of our clients have done their own stuff for years, and they come to us and say, Matt, I've done this for years, but I can't do it now because I know I'm getting ready to retire, and I don't really know if I have everything in place. We'll help you understand where things are, and we'll give you ideas on how we would moving forward. The blind spots is key, identifying blind spots that you have. And especially coming after a year of COVID, after a year where so many people were impacted, it's a good way to say, here's a checkup to see where I'm potentially at to make sure I'm on pace. So that is our ask of you. You'll see a couple things. Again, I appreciate your time today. My name is Matt Maiers. Again, you'll see my contact information there. Beyond that, again, please take the time to schedule a complimentary consultation with us. We've blocked off times in our calendar over the next 2 weeks and into June that we are available to do that for you. In the bottom right, you're going to see a poll that asks us a little bit more. If you've taken some time and maybe put some questions in, great. If you haven't, please take a few minutes to take our poll, write some things in there that you liked about this, whether it's taxes or if there's other areas you'd like to see us work with you on. Let us know what those are. It's a way for you to kind of go through what some of those areas might be. And please rate the presentation. We love doing this presentation, but we want to make it better and better and better. So your feedback is extremely helpful in doing these future things for other people. So on that being said, I want to thank you for your time. Your attention is really appreciated. We hope you found some great information. Know that there's a lot of changes going out there, but not all of them are bad. And if you take the time to plan for them, then you can coast into knowing that you have these things set up. You'll have some sense of financial security, tax optimization in place. that can work well for you for the long term. So thank you again for your time. On behalf of Joe and myself, we appreciate it, and we hope to see you soon for a 30-minute consultation.